Now we know that things in Washington have gotten ridiculously complex, messy, ugly. Eric Singer has a new book out in which he tries to actually quantify that cost. You've done a lot of research, Eric. Tell us, just what did you find exactly? How much are they sticking it to us?
Well, they're sticking it to us in money that we could have made, we don't know is missing. I did a lot of work on the impact of Congress over a long period of time on the stock market. And what I found is that on days that Congress, over the last 47 or 48 years, on the days that Congress is in session, the market goes up less than 1% annually. And on the days that they're on vacation, it goes up over 16% annually. There's a level of statistics at which you no longer really think it's an anomaly. The data I just gave you was looking at 12,000 trading days. It had 7,900 days when they were in session. It had 4,100 days they were on vacation. It seems to me that Congress is a cause, it's not a coincidence.
So what's that telling us exactly? That when they're in session, they're doing things that, hurt the economy?
Well, when they're in session, everybody's much more exposed to legislative risk. So the market has to discount, are they going to change the rules for the banking industry? Are they going to change the rules for the healthcare industry? And when the market discounts the possibility that it might be a change, it shows up in less capital appreciation when they're doing their job.
So most of us, when we see this kind of dysfunction in Washington, we roll our eyes, we're cynical. You actually are kind of going at it head on. You actually invest according to this. Is that right?
Well, first of all, just let me say I yield to no one in the level of my cynicism or my ability to roll my eyes. But aside from that, I've looked at the damage that Congress causes on a daily basis, and I try to sidestep it I have a mutual fund where I only invest on the days that Congress is on vacation. Over the last 6 years of audited returns, or nearly 6 years, I'm pretty close to the S&P with a little over half the risk during that time.
Explain the logistics of that. So when Congress is in session, you're out of the market completely?
I'm either out of the market completely or I have long and short positions that offset each other, so I'm neutral.
When they're out of session, you're what, in the S&P?
I'm just long the S&P.
You're just long the S&P.
And just the S&P, not individual
Now,
stocks.
how many days is that actually? So how many days a year is Congress in session?
Congress is typically in session about 160 or 170 days out of 252 trading days in a year. I make my returns on the 60 or 70 days that they're on vacation. Think of it almost as a way of managing the news cycle. You're trying to manage to avoid headline risk. You're trying to manage to avoid the daily impact of legislative risk.
The other point I would make, though, is that I could see longer term where the markets would start to get worried about debt issues. I just haven't seen it yet. What I've seen most often is conservatives talking about fiscal responsibility, but what markets seem to really like are bailouts and easy money. And it seems time and time again when the Fed said, yes, we're going to act, markets would go up. When we said, yes, we're going to do stimulus, markets would go up. That's just what I keep seeing, whether in the United States, whether in Europe, whether in China. That just seems to be the way it plays out. Do you not buy into that?
I agree with that on a nominal numbers basis. In other words, if you look at the S&P on a nominal basis, there's no question the market likes easy money. If you look at real returns, and I like to look at real returns by dividing the gain in the S&P by the change in the price of gold. The market's up 50 or 60% since 2008, the 2008 election. Gold has more than doubled, and people feel squeezed on the actual stuff they have to buy, like gas and food.